Welcome, everybody, to Alpha Bets, a weekly conversation where we pick apart the business drivers of interesting companies and what powers them and leads to their demise. I'm here today with Ross Klein, the CIO of Changebridge Capital, and our resident stock detective, Pat Connolly. My name is Nathan, and today we're jumping into Callaway. Callaway's legacy business is making golf equipment, clubs, balls, etc., but they also have some adjacent brands that don't have to do with golf, as well as they recently branched out by acquiring Topgolf. So to start off with, Pat, what is the purpose of these adjacent brands like OGIO, Jaff Wolfskin, Travis Matthew that aren't necessarily golf brands, but they're these adjacent apparel brands? Why has Callaway been acquiring them? And what's the strategy with owning them?
I think they require them to get a more global reach on their revenue. I kind of think it's like almost like a hedge against golf apparel in general. Maybe they're tapping into existing distribution channels with their retailers. Like, hey, we have these new brands. Can you sell these while you're distributing our Callaway brands? It's a little odd. They're not totally golf brands. They're a little off.
Ross, do you see these other brands as a good hedge?
It's a little odd, right? So they did acquire these brands when golf broadly was doing much more poorly than it is now, right? And so at the time, it might have seemed like a logical diversification opportunity. Now, however, I think it's being framed as a chance to cross-sell their existing customer base. And they could. It's not inconceivable that they're able to do that, but it is a bit of an odd fit within the broad Callaway brand.
So you mentioned that golf was not doing as well before as it is right now. Prior to COVID, inventory at Callaway's was ballooning. Revenue wasn't growing as fast. They weren't collecting their receivables and things were just going bad. But then COVID hit and things turned around and they got saved. Can you walk us through how COVID saved Callaway?
Yeah. So, I mean, broadly speaking, everyone had to go remote and there was only so much time that we could stay remote and we needed some sort of outdoor activities to get back to life. Golf was outdoors. It was socially distant. It seemed safe. There was a huge spike in golf demand that's actually persisted through 2021 pretty well. That was just a total savior for this business. You saw it across other business segments too. The gun companies had bloated inventories. They had poor balance sheets. They got saved by incremental demand during COVID. A lot of on-premise retailers, mall-based retailers, but Callaway and Titleist were both very much beneficiaries of the remote lifestyle and social distancing that was required as a result of COVID. If not for that, the balance sheet situation was precarious at best.
The other interesting part of the business is Topgolf was acquired by Callaway in 2021. Pat, can you walk us through some of the details for that? What's the business model? What is Topgolf?
Topgolf is like a venue. It's a driving range. It's kind of like you eat there, you drink there, you play golf. It's really accessible to all people. It's not just golfers going there, all genders, all ages. Everyone has fun. It's really big for corporate events. So a third of the revenue is from events, and COVID kind of put a stamper to that. But walk-ins were healthy, and it was pretty much COVID-proof. Topgolf also has a couple brands like Top Tracer, which they kind of licensed the ball tracking technology to local driving ranges, which I think is really interesting. And they also use the Top Tracer technology on CBS if you're watching golf on TV. So that little graphic, that's Top Tracer technology.
Going to the acquisition, what did Callaway pay for Topgolf and what did they get for that?
Topgolf was actually a merger. They always owned a little bit of it and they kind of just went all in.
Yeah, so they paid $3 billion for Topgolf. They owned a stake in it already. They recorded a gain in that existing stake. Their initial investment in Topgolf was brilliant. There's no question about it. The acquisition, $3 billion. They acquired somewhere around 1.2 billion run rate revenue this year, maybe 150 or so in EBITDA per the company. That in and of itself is a pretty reasonable multiple and valuation, paying less than 20 times EBITDA for a business that was set to double units in the next 5 years per the company. That's really not that bad. It's a high return on invested capital business for something that is so capital intensive. It's high margin. It seems to have runway for growth. But one of the interesting little things that they bought in there was Top Tracer, which Pat just talked about. In Top Tracer, this is software revenue. It's high margin. It's largely recurring, although there's some usage component to it. And you're looking at a run rate above $60 million in annual revenue. So you could probably put a healthy multiple on Top Tracer alone and say, this was a pretty reasonable acquisition. The flip side of that argument, though, is it costs 20-something million to build one of these locations. There's 66 of them already. The company spent $1.5 billion, and we're paying $3 billion for it. There's obviously some premium to the brand and the IP and all of the marketing that's gone into it. You might ask yourself, what's the barrier to entry to a Topgolf?
What's the average revenue per location for Topgolf?
Give or take about $20 million. Depends on the size, the location. It depends on how long it's been in operation, but that's a reasonable run rate to go with. It's a business that Topgolf alone is generating 15% operating margins, and it's still subscale. While these businesses are in their growth phase, they're spending a lot on pre-opening, they're spending a lot on marketing, they're spending a lot on new location scouting. As growth slows, and margins do tend to pick up.
Pat, what do we think the addressable market is for Topgolf, and how long do we think it'll take to get there?
I think they give a TAM of 200 domestic units and 50 international units. So Topgolf will own the domestic units and then franchise out the international ones. So maybe the franchise TAM is a little understated. Yeah, if you can do 200 in the United States, why could you only do a quarter of that across the rest of the world?
Let's talk a little bit more about Toptracer. So that technology aspect of Topgolf, pretty interesting. What more can we talk about as far as the upside that Toptracer represents?
It's really a play on data. So if you're really practicing every week and Toptracer has your data, you're going to go to a driving range that you can track that data to see how you're swinging the club. And then maybe Callaway can be like, hey, maybe you want this new driver to add 10 yards to your drives. And then you can compare your data with friends. There's a lot of, data is new oil, and that's a data point that never really existed before. And now you can get it reasonably easy. And this is data that the pros have. Why wouldn't you want it?
Ross, does this data lock in customers and create customer loyalty and offer something that they can't get anywhere else?
Does it lock in customers? No, but does it create brand loyalty? Does it give them an opportunity to cross-sell? If you're seeing a Callaway logo every time you go to the driving range, that's pretty targeted marketing. It's interesting because in the last year, with so many new entrants to golf, Callaway is a high-end brand. They haven't necessarily been the first beneficiary of that trend. But as those new entrants become more seasoned, Callaway wants to capture that market.
I definitely see a lot of synergies between Topgolf and the Callaway brand. Maybe there'll be clothing in the Topgolf locations. They're pretty big locations. Maybe you buy your new clubs through the app on your Toptracer range.
Pre-acquisition, the valuation was pretty reasonable. They owned a portion of Topgolf, and then they went all in and basically merge with them. Any more thoughts on possible negatives or way that could be higher risk than what we'd like to see?
Yeah, so it's incredibly capital intensive. They're spending more than $20 million to open a unit. They're not going to generate the sort of free cash flow that they would have if they hadn't bought Topgolf. And they just spent $30 million to acquire a stake in something called 5 Iron, which I haven't been to a location. The description sounds an awful lot like Topgolf. You've got to be a little bit concerned about what are the moats to launching additional versions of Topgolf. How many different versions of Dave & Buster's are there? The addressable market might be what they're claiming it to be, but their ability to capture it isn't necessarily a given.
Looking at Callaway altogether, prior to COVID, working capital was dragging. Do we know why working capital was such a drag prior to COVID?
Yeah, people weren't buying their products the way that the company expected them to. So dealer inventory was getting too high, but demand picked up meaningfully during COVID. Remains to be seen is whether or not those initial entrants to golf keep it up when the rest of the world sort of normalizes, assuming that happens. And assuming that they do keep it up, will they price up to Callaway?
What should we be thinking about from a macro sense when we're thinking about Callaway and Topgolf?
Demographics, the stereotypical old person golfing in Florida when they retire. So the baby boomers are retiring. We have the kind of call option if the women ever really adopt golf on the same level as men. If there's ever a female Tiger Woods that inspires a whole cohort of new golfers. In just general, people becoming more and more enthusiastic about it. So if you're working from home, you can typically golf more often and you hit the driving range more often. People say it's an addictive sport. So there's potential there. There's potential for more enthusiasm in the sport.
Keep an eye on consumer discretionary spending just in general. Golf is not a staple. If we're starting to spend more on gas and utilities and food, perhaps it has an impact on our ability to go to a Topgolf and spend a couple $100s or buy new clubs or go to the driving range quite as often. That hasn't been representative yet, but it's also the first time we've had real inflation in a long time. So it's something to keep an eye on.
So Ross, is there anything that Callaway or Topgolf can do to help their margins? They're getting squeezed on margins due to supply chains. What can they do to combat that?
They're going to have to raise prices. They've talked about doing so. Price increases are coming per their last conference call. But the last quarter, margins got squeezed. Topgolf was fine, But the legacy Callaway business, the input costs are rising. The cost to move these products around the globe is going up faster than their price increases were going up. And so they said that they have a plan in place. It's something really important for us to keep an eye on, because Topgolf doesn't generate a whole lot of free cash given capital expenditures needed to open a new location. If the core legacy business is also showing margin headwinds, then overall business is not going to be this sort of investment opportunity that investors who used to own Callaway are used to seeing. And so you might see some churn as folks start to look towards future growth a bit more than they're used to in Callaway.
Pat, if you were to buy Callaway, what would be the main thesis that you would get behind?
Definitely Topgolf would be the number one reason you'd be excited about the stock. You definitely view Top Tracer as a hidden asset, and you kind of have to hope and pray that the apparel brands stay hip and cool. People still want to buy Travis Matthew, still want to buy Callaway apparel.
What would you be arguing from a bear case?
I would say they have too much leverage to their apparel business, and that the brands can't possibly stay cool forever. Not everything's a Nike, not everything's going to last forever. Then you could say maybe Topgolf, we see that the honeymoon phase that they talk about on location starts to become a 2-year honeymoon, a 3-year honeymoon, and people really aren't going to the Topgolf as much because you only go once or twice and you get sick of it.
Ross, if you're thinking from a bear case, do margins and supply chain issues and ability to raise prices make your top 3 reasons to be bearish, or what would you say is your top bearish reason?
Top 4, I would add Topgolf comps and barrier to entry there. You know, in the last quarter, they said that they were effectively back to Q3 of 19 volume and revenue per location on a same store basis. But a lot of the other peers that they have out there, like a Dave & Buster's and like a lot of restaurants, they're actually showing better than Q3 19 numbers in Q3 21. And so it's just something to keep an eye on the fringes. Can they fully recover? And then what's the growth prospect from a same store sales perspective going forward?
All right, so we're called alpha bets. What's the bet that we're making? So a year from now in 2022, Pat, where do you think Callaway's stock price will be and why?
I would say it underperforms the market. It wouldn't be a terrible thing to own, but I don't think it's something that's really positioned well. It sounds like a reopening play, but it was a really never closed play. And it's kind of always, it's like a lame reopening play.
They're not really a reopening play because they were always open in the pandemic. Why do you think that Callaway will underperform the market?
Rising costs due to supply chain, rising wage inflation at the Topgolf locations. They're pretty staff intensive locations. You got a kitchen, you got a bar, you got costs to build out, material costs are going up. So nothing's really going in their favor cost wise. Demand wise might be stale, and the apparel exposure could fall off a cliff if it becomes not cool anymore. Who knows?
A year from now, where do you think Callaway's stock price will be, and what will be the main reason for it landing there?
I'll give you an if then. If demand for golf is able to sustain at the levels we saw this year, this is probably a pretty interesting company to own. That said, the comps off of 2021 are going to be really tough. I think it's very much based on that. I think Topgolf is going to do in the short term what it is going to do, but the core legacy business has a lot of variability based on overall golf demand.
If you have questions or comments to our listeners and viewers, go ahead and put them in the comments. We would love to talk with you more and track Callaway as we go through this next year. Thanks so much, everyone. See you next time.